And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Real Estate Investor Radio Show. I'm Mike Harrison, and as always, we're working on your financial freedom. We're going to dip into an email from one of our listeners today. I try to do this every few weeks, but if you've got a question and if there's an opportunity to hit it on the air, I'll do it. But my email address is askmike@luinc.com, askmike@lu Inc. Lifestyles Unlimited Inc. essentially is what that stands for. Send it to me. If nothing else, I always respond personally to each and every email I get. So here we go. Hi, Mike. I hear you on the LU show and love your approach. I'm not a real estate investor, but looking for something different and a better way to increase returns. I think I may give this real estate investment approach a shot. If I were to come in with $150,000 to start, what are my options? I look forward to your response. Okay, I'm definitely going to go through, it's going to be later in the show, what you can do with $150,000 as a real estate investor. And it's quite a bit. It's more than maybe you even realize that you can do with $150,000. That's a big chunk of money to come in with. It's a great chunk to get started with. And there's several options that we'll review. But all in all, that's a very open-ended question. I do have a little bit of concern, and let's go back to his words. He says, I think I may give this real estate investment approach a shot. So it sounds like he's obviously involved in the stock market. Most people are, right? Quote unquote, 70% of investors in the United States are all stock market mutual funds. And of course, that's what we're all taught and told and conditioned from a young age, that that's how you eventually create a retirement for yourself. Obviously, I disagree. You've heard me talk about that. All the hosts talk about that on the show, that really that's more gambling. But we need to dig into some of that mindset. Now, I'll also say this, about 3 or 4 times a year as my real estate investments run full cycle, I can't say I don't have some of those thoughts similar to yours, because we'll get money in, an investment may sell, and now we've got this chunk of change that we need to deploy, and the thought process always starts, right? Maybe there's a lead investor or two that are putting some syndications together, and we always take a look at that. I can't say I've ruled houses out, even though it's been a few years since I've purchased a house, but heck, I was mowing the lawn just last week and went ahead and dialed up podcasts. Al Gordon did a great show about some deals that are out there for home purchases. He reviews some of the email blasts that our realtors will go out and they'll analyze the opportunity, and they send it out to our members, and our members can purchase those homes if they want. And Al does a deep dive. I can't say that my mind, as I'm going into that show, I'm thinking, heck, maybe we need to take a look at houses again. I mean, obviously, this is a market cycle that we haven't seen for about a decade, and it's creating some huge opportunities to invest in single-family homes. So, yeah, I have those thoughts. Just like other folks out there, when you get that chunk of change, what are you going to do with it? How are you going to deploy it? And the important thing is it needs to be deployed, okay? You don't want to sit on cash, especially in this high inflationary environment that we have. Now, there's some opportunity to put that in some maybe a money market account or some high yield savings account, but those are temporary answers. If a real estate investor doesn't want to sit on a ton of cash unless they're putting money aside for an opportunity. I can tell you something else that came across. One of my favorite lead investors in all of Lifestyles Unlimited just had a fantastic opportunity that went by, and I passed on it purposely because I have ideas of what I want to do with my funds and how I'm going to deploy it, and that's about the third great multifamily syndication opportunity that's come across here in just a few weeks, and it hurt. It hurt me to pass on them, but no, I've got an idea in mind what I'm going to do with my funds, and we're putting that together now. So for your listener, I want you to understand it's not just I think I'll give this real estate a shot. There is a very, very large educational piece that comes with real estate investing. It's so important. Your first investment's in yourself, and that's that education. Stock market investing, there's no education that's required. I can go online right now and find an online trading company, and I think you know the names of those companies are all out there. I could open an account, probably have that account open in just a few minutes, and immediately begin purchasing stocks or mutual funds. And no one's going to make me get educated before I do it. No one is going to try to protect me. It's the Wild West. You can go ahead and do that. But real estate investing, at least through Lifestyles Unlimited, we're going to put you through an educational program. And it's so important that you understand what you're doing so that you can make decisions based on strategy. You can make decisions based on what your personal goals are. And they're educated. They're smart decisions if you understand the entire investment, okay? I would respond back, real estate is a long play, all right? There are some syndications that we invest in that take a while to come to fruition. It's a long play compared to the stock market mindset. Timing is crucial to the stock market investor. We don't consider timing in real estate. Either the deal makes sense or it doesn't, but timing is everything to a stock market investor, right? Dale Walmsley does a great analogy about stock market investing versus real estate investing. And he says within real estate, we can adapt. We can see if we're standing on the tracks, okay, if we're standing on some train tracks and someone says, hey, that train is going to hit you when it comes along. Well, we'll see that train way off in the distance, and we just step off in the track and get out of the way. That's real estate investing. We can adapt, but stock market investing, well, that's like someone putting a gun to your head. Bam, you can't get out of the way of that bullet, right? If you're a stock market investor, you can wake up tomorrow morning and the market has crashed 10%, 15%, 20%. Even while it's crashing, if you're in mutual funds, you may go online and put in your sell order. But guess what? Those sell orders on mutual funds are not realized till the end of the day. So you've got to write it out for the next several hours, and then your sell order is placed. So you can't get out of the way, essentially, of the downturn in stock market investing. So if you're a short-term investor, I'm going to advise you, I'm just going to say that you don't have your mindset right for real estate for sure. Now, there are people out there that do believe real estate is a quick hit. Now, these people will go buy a poor property, they'll fix it up, and they'll sell it. That's flipping. There's a gazillion TV shows all day long that show these flippers are buying bad properties, and they're fun to watch. I love to see what some of these folks do, but that's not real estate investing. That's flipping. That's a job. The income from that is treated different, and you've got to buy, sell, buy, sell, buy, sell, buy, sell. You've got to keep it going, and people think that that's real estate investing, but I will tell you, it's not. For instance, our income as a real estate investor is rarely, if ever, taxed. We're going to talk more about that later. But if you're flipping a property, that's taxed, okay? That's taxed all day long, and you've got to track that, and you've got to pay your taxes at the end of the year, if not quarterly, because essentially you're running an investment. So if that's what you think, if you think real estate investing is a short-term investment, just jump in and jump out, then it's really not for you. It's a long game. 3 years, 5 years, 7 years, possibly longer than that. Now, have I been associated with deals that have gone full cycle in less time? Yeah, absolutely. Just last year, there was a property that we had that sold, and it sold, I want to say 13 months after the original date of purchase. It was a 65% return in 1 year. That wasn't the plan. When we went into the property, we figured it would be a 2 or 3 year hold. However, the metrics that the syndicator, right? We call them lead investors, but they're syndicators are putting together this purchase of a multifamily property. The metrics that he had pegged for year 3 essentially hit within 1 year, and we sold at the right time. So that was a surprise. It was a very nice surprise. Like I said, 65% return in 1 year. Who wouldn't want that? But that wasn't the plan initially. Now, with those funds, we need to redeploy those. So I want you to understand, if you get $150,000 in real estate, as these deals go full cycle, you're going to want to redeploy those. There's a couple of reasons. Obviously, cash flow, right? It's all about creating cash flow for yourself. So if you have a property, let's just say it's a multifamily investment and it's paying you your quarterly dividends, and that equals $5,000 a year. Okay, let's just say. Well, if that property sells, then your cash flow just decreased $5,000 per year. And I will tell you, you kind of get used to the cash flow, right? This is why we do it. So you're going to need to redeploy those funds into a new investment and bring that cash flow back up, if not more than it was before. So you keep redeploying. Now, also another reason to redeploy, and I will run into this, is taxes. And I talked about that earlier, but there's a nice rule, and it says passive losses within real estate offset passive gains. So if I've got, for instance, that property sold, it was a capital gain of 65% in 1 year. So I got my initial money back plus an additional 65% on top of that. You are obligated to pay capital gains on that 65% return, okay? But if I have these other investments in other multifamily properties and they're depreciating those properties, we're getting a K1 back. And when we do our taxes, it may say property A, you made $5,000, but we depreciated it $30,000. Property B, you were paid $7,000 over the year, and we depreciated it $16,000, whatever that is, and it changes year to year as they offset. But that offsets, essentially, I stack those up, and it offsets that 65% return, so that I didn't have to pay any taxes on that. What a nice feeling. My name is Mike Harrison. We'll continue talking real estate investing on the other side.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
I was at a seminar one time and a guy was sitting up there and he was saying, what you really need is you need the young, aggressive entrepreneur people to go out there and take that money and invest it with them. I walked up to the front of the stage and I said, hey, I'm that guy you're talking about that should be mentoring these people on how to do this. The guy goes, sir, we don't allow solicitation. And I said, no, you don't understand. I'm here to tell you I'm exactly the guy you were telling them to look for. And I'm willing to help them for nothing. And the guy goes, if you don't stop soliciting, I'm going to have the security come and get you. And I said, I can see you're a scam. I'll just leave. Everything I said had gone through the intercom. So I walked out of the seminar room and 200 people followed me. And that's how Lifestyles was started.
Are you ready to get up and follow Dale? Join us today at lifestylesunlimitedworkshop.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the show. I'm Mike Harrison. If you have any questions or comments, please send me an email. AskMike@luinc.com. AskMike@luinc.com. And I'm reviewing an email on the show today from one of our listeners. And essentially, he's considering about investing in real estate, and he has $150,000 to start with and wants to know what his options are. My first question back was essentially, what's your mindset? Are you a short-term investor or a long-term investor? And real estate really is the long game. although some of your investments may turn pretty quick. And I reviewed one of those investments in the previous segment that basically was about a year. We held it for a year and it returned 65%. Now, I have two other investments that I'm in, and this is why we call it a long play sometimes. Both invested in 2018, okay? So it's been at least 5 years, right? 18, 19, 20, 1, 2, 3, 6 years, okay? Some of these are coming up on 6 years, and we entered into them in 2018. One of them has been kind of a slow roll, just chugging along, very predictable. And the other one has been white hot. I mean, laser focused, just a fantastic investment. Now, the slow roll property, full disclosure, that lead touted that in his business plan as a 10-year hold from the beginning. Okay, it's a yield play. So he says, hey, here's this property. We're planning on holding it for 10 years. Here's my pro forma. Here's my analysis. Here's why this would make sense for somebody if you wanted a yield play, okay? So he told us from the beginning, we're going to hang on to this property for a long time. So I'm not surprised about anything. It's that thing pays, automatically, just one quarter at a time, go, go, go. Now, the one that's white hot, now we initially planned on this as a 3-year play, maybe a 5-year play. That's how it was sold to us. But I will tell you, this property has exceeded all expectations, okay? It has done absolutely fantastic. It's so good that none of us as investors want it to sell, okay? We don't want to sell right now. We're going to hold it. We're going to ride this horse and continue riding it. It's a fantastic opportunity. So that's an example of a property, of an investment outperforming, okay? Here's our plan. It's outperforming. The other one was it's doing everything that the lead sold to us that it would do. That's that 10-year hold. Now, the second thing I wanted to know, what are you trying to accomplish? Or do you want cash flow or do you want wealth growth, okay? Those are two distinct different strategies. Wealth growth, what I mean by that is, and we'll go into houses a little bit, but if you were to, there are opportunities right now where you can buy a house and you can make 100+% equity capture in that purchase. And I'm going to explain that. And Al, if you find Al Gordon's show from about a week or two ago, he'll talk about that quite a bit in all three of these properties that he reviews. But equity capture is where you go into a property and it's beat up, right? I mean, they let the animals run loose. They never did any landscaping. They deferred all the maintenance. It probably needs a new roof. It probably needs a new AC, hot water heater, all that good stuff. You're buying this property at a discount, and the intention is you're going to fix everything in the property. We teach you this here at Lifestyles Unlimited. So in doing so, you may come out of pocket $30,000, let's say. But in that $30,000 that you invested into the purchase of that property, and if you structure your financing properly, use a hard money lender, and then come out of that to a conventional lender, you'll find that the property will have some equity. So, for instance, let's say you bought a property for $120,000 in really, really bad shape, but once it was fixed up, it's worth $200,000 or $225,000. Okay, so that's where that equity capture, and you can get properties right now with over 100% equity capture. Okay, so that's what we talk about wealth growth. It may have smaller cash flow. It may only be cash flowing $200 or $300 a month in that particular investment that I'm describing. Okay, so if you're into wealth growth, that's a strategy you can do. If you're into cash flow, then it's a completely different. You're going to look at those investments up front, and you're going to want to invest in a property that has a cash flow that matches your strategy, right? Many of the houses that I had purchased in the past, we had cash flow well in excess of $500 per property. At one time, I had one that had a cash flow over $600. Okay, so two completely different strategies. You need to think those through, and you'll put your strategy together the more you become educated. And like I said, you need to get that education piece in the front. So we're just going to assume that that's part of your involvement. You got to get educated first, and then you can develop your strategy and deploy from there. Now, the third thing I want to ask you, and I mentioned this, Are you looking for lots of involvement? You want your hands involved in everything you're doing because we have that ability for you. I mean, you can work as hard as you want as a real estate investor, or you can work as little as you want, okay? You can work as little as you want. You can be a passive investor, which I enjoy passive investing, but it's literally hands off. It's at arm's length, and legally it's set up. Those are the rules of the road, essentially, that it is an arm's length play. You study the private placement memorandum. You decide if that is something that you fits your strategy and that you want to invest in this multifamily property. And if it agrees with your strategy, you simply wire the funds to the lead investor. And then once he closes on the deal, you're a passive investor, and your percentage of that deal may be, anything from 0.05% to 1, 2, 3, 4%. Just depends on the raise, right? How much is being raised to purchase the property? So if you've got some smaller properties, that lead may only be raising $1, $2, $3 million. Or if you have larger properties, that lead, we just saw one the other day, a $22 million raise. That's a huge chunk. So you can see that your percentage of ownership is different with each of those passive opportunities. But that's truly arm's length. So if you don't want any involvement, if you just want to kick back and put your money to work for you, then passive investing is the play. If you want to be very involved and hands-on, essentially, we've got that. So let's say you wanted to become a lead investor. And if I'm just doing thinking out loud here, a scale of time and involvement depending on what kind of investor you want to be. So our lead investor, that is the most. That's going to be a 5 as far as involvement. They have to be very involved. Now, the advantages of being a lead investor, it is the fastest way to grow wealth. Absolutely, because you're using leverage. You're putting together essentially a syndication, a purchase of a large, it could be a large multifamily property, but if you're buying a $5 or $6 million property, and you're going to be the lead investor on that, obviously, you're going to bring in these passive investors as a partner. You're required to put a certain amount of money into that opportunity as well, so you have ownership in it. But you're very involved. That is a 5 as far as your involvement. And passive, I'm going to put your involvement as 1, okay? Your involvement factor as a passive investor is 1. But your wealth growth is slower as a passive. Now, the reward, less time, right? So that time of involvement, that 1 to 5, lead is definitely 5. You're very involved. You're managing, essentially you're overseeing the partnership, you're overseeing the asset itself, and you're overseeing your company that owns that asset. So you're dealing with your passive investors on one hand, you're dealing with the financials to the bank on the other. The accounting needs to be in order. So lead investor, it's a job. People will tell you that is a job, okay? Now, there is another one. It's an independent property owner, an IRO, independent rental owner. That could be very busy at first. If it's you and you're answering to you. So that side of it is taken away from you, right? You're not having to essentially send out these monthly reports. You do have the bank to take care of, right? We put leverage on everything. So I'd put an IRO. You may be in the very beginnings of that investment at a level 4. An IRO can easily come down to a 1. You get everything done that you need to do. You build in your forced appreciation. It'll always have intrinsic value in that property, and it's a great way to build wealth. So depending on the size of that property that you buy yourself, the timeline's going to be different. The project type's going to be different. Right? You could buy one from another investor. That happens at Lifestyles all the time. And it may already be stabilized. You could walk in and it's a 1 as far as your involvement, 1 or a 2, right? Obviously, you're taking care of the books and the leases and all that. And houses, you can be as busy as you want or as busy as you don't want. I can tell you self-managed, if you're setting the property up, once you get it stabilized, there's not much to do there if you've got the right resident. So you can be as busy as you want or as busy as you don't want. I know a member of Lifestyles Unlimited. Well, I know several that own greater than 20 houses. I know one that owns, Don, if you're listening to me out there in Virginia, he and his wife own and manage 174. I believe that number's right. But Don, he's as busy as he wants to be, and they're able to do that. So houses, you can be as involved as you want or as involved as you don't want. Having more houses doesn't necessarily mean that you're that much busier. So think about that on your investing side. So now, what can we do with $150,000? Let's take houses, and let's say you decide to go deep value. You should be able to get 4, 5 houses, possibly 6 houses. Those opportunities are out there right now. So if you were to do deep value plays, you start turning those properties every 2 to 3 years, do it again, do it again, do it again, play the long game. You can easily turn that $150,000 into $500,000+ in just a few short years. Okay. Now, passive investor. If you wanted to take $150,000, I'd probably break that into 3. I'm just telling you what I would do. I would break it into 3, and I'd invest $50,000 into 3 different properties with 3 different lead investors in 3 different areas, not all in the same city. Spread it out. Maybe it's all in the same state if you wanted to, but I want you to understand it's going to take you a while at $150,000. Passive investing is a little bit, it's a longer play, okay? Just understand that going into it. So you've got a year, and then it begins cash flowing in year 2, right? And cash flows through, and then maybe in year 3, there's a refinance or a sell. So it's a little bit longer play. What are your risks there? Well, 1, make sure you get that right lead investor. Like I said, you've got to meet these people. You've got to network. You've got to have a relationship with them. So make sure it's a lead investor that you're happy handing your money to. So that's crucial on the choice. Make sure it's a property that you understand, right? Make sure you know what the financing is. Make sure you understand the business plan. That's why there's this upper level education that we have. And then the risk, well, there's hailstorms, there's fires, there's floods. Insurance is always going up. Taxes are always going up, okay? Make sure you understand all of that. If you've got $150,000, you don't want to invest all that money into 3 properties on the coast, right? Now you're at one hurricane can push that cash flow out for some period of time. If you're in North Texas, one hailstorm can maybe cause a pause on distributions. Well, we have to pay our deductible and get a new roof, okay? Keep that in mind. These things happen. They don't always happen, but they do happen. Now, as an IRO, I would tell you for $150,000, it's probably going to be very difficult for you to find a small apartment community. Yes, we use leverage, but let's say the bank is going to bring approximately 60% to the deal. It means you can probably buy a property, I don't know, with the right financing that's worth about $350,000. Maybe you can find a 5-unit, but it's going to be a very small property with if all you have is $100,000. And think about it like this. I mean, most multifamily properties out there, not all, most have a value that's $100,000 or greater per door. Okay, so if it's at 150, there's all your money, right? So and that's just a 3-unit. Remember that an apartment community needs to be 5 units or more. So it'd be difficult for you to take that 150, but again, maybe you put it into houses and you churn it and you churn it and you churn it and you churn it, and we get forward in time, you've got $500,000. Then we can start looking at some small apartment properties if you want to take that independent rental owner route. Now, lead investor. This is a lot of work. This is very hands-on. It's the most education, but you're going to be able to take that 150 and you need to come up with 10% of the raise. So that'll allow you to raise $1.5 million. So now you can see you might be able to purchase a $3 million or larger property. So you have that ability. Hope I helped you out. My name's Mike Harrison. I want you to remember, it's not the money, it's the lifestyle. Make it a great day.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.